the father of principle, lessons from the life and times of Benjamin Graham. Well, good morning. It's a privilege to gather once more to discuss the foundational minds of our craft. We've explored the great practitioners, the builders, and the thinkers who stood on the shoulders of giants. Today, we turn our attention to the man who was, himself, the giant, the bedrock upon whose shoulders all others stand. He was the original architect, the man who gave investing its intellectual framework, its analytical rigor, and its moral compass. Before him, the stock market was largely viewed as a speculative casino, a game of tips and trends. After him, it could be rationally approached as a field for disciplined, principled business analysis. He transformed a pursuit of luck into a profession of logic. His name was Benjamin Graham, and his story is not merely one of personal financial success, but of creating the very rule book, the Constitution, from which all subsequent value investors have learned to play and win the game. His life was a testament to the supreme power of principle over panic, of calculation over conjecture, and of the unshakable belief that in the long run, facts must trump feelings. Act 1. The Forging of a Disciplined Mind. From scarcity to security, to truly understand the philosophical engine of Benjamin Graham, one must first understand the crucible that forged his worldview. Born Benjamin Grosbaum in London in 1894, he emigrated to New York City with his family as a young boy. His childhood was marked by a defining trauma. His family's savings were wiped out in a financial panic, an event so severe his mother was forced to pawn her jewelry to make ends meet. This early, visceral brush with financial ruin left an indelible scar. It instilled in the young Graham a lifelong, almost pathological desire for security and a profound, empathetic understanding of the devastating real-world consequences of market mania and fragility. For him, money was not abstract. It was the thin line between dignity and despair. He possessed a formidable intellect. He graduated as the valedictorian of his class from Columbia University, excelling in philosophy, mathematics, and classical languages. He was offered teaching positions in 3 separate departments, a testament to his rare synthetic mind. But he made a deliberate, pragmatic choice. He turned his back on academia for a career on Wall Street. His motive was not glamour or greed, but that deep-seated need for the security that had eluded his family. He entered the financial world in the Roaring '20s, a period of dizzying speculation, soaring prices, and ubiquitous optimism. It was an era where stocks were seen as tickets to a perpetual party, not as ownership stakes in underlying businesses. But Graham was constitutionally immune to the fever. He was not a speculator, he was a born analyst, a forensic seeker of facts and figures in a world drunk on narrative. Even amidst the euphoria, he began to develop his core methodology. He observed a fundamental, often ignored truth. The market price of a stock and the underlying business value of a company were frequently 2 entirely different things. While the crowd chased momentum, he began to quietly, methodically search for discrepancies, situations where he could buy $1 worth of tangible assets for 50 cents. He focused on hard, countable things: net working capital, current assets minus all liabilities, book value, property, plant, and equipment. This was the genesis of a systematic, almost scientific approach to finding what he would later formally term the margin of safety. It was an island of arithmetic in an ocean of emotion. Act 2, the crucible of the Great Depression and the birth of a doctrine, the Great Crash of 1929. And the ensuing decade-long depression was an unparalleled catastrophe for the global economy and for millions of individuals. For Benjamin Graham's nascent philosophy, however, it was the ultimate, if brutally painful, validation. While the speculative edifice of the 1920s crumbled into dust, his focus on tangible asset value and a disciplined margin of safety provided an anchor in the storm. It is crucial to note he was not magically immune. His own investment partnership suffered significant losses in the early 1930s. But his disciplined framework allowed him to analyze the wreckage, understand his mistakes, and, crucially, to systematically refine his principles based on empirical failure. He learned not just from success, but from the harsh tutelage of disaster. It was in the sobering aftermath of this crisis that he, alongside his brilliant colleague David Dodd at Columbia University, penned the Bible of the craft. The book, Security Analysis, first published in 1934, was far more than a textbook. It was a manifesto for rational investing, a bulwark against the chaos that had just consumed the world. For the first time, it provided a comprehensive, rigorous framework for distinguishing investment from speculation. Graham laid down a definition that remains canonical. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. With this sentence, he drew a bright moral line in the sand. He then gifted the world his most powerful and enduring allegory, Mr. Market. Imagine, Graham proposed, that you are a partner in a private business. Your other partner is a fellow named Mr. Market. Every single day, without fail, Mr. Market. Market arrives at your office and names a price at which he is eager either to buy your interest or sell you his. The critical flaw is that Mr. Market is wildly, incurably emotional. Some days he is euphoric, buoyed by sunshine and good news, and he offers you a fantastically high price for your share. Other days he is deeply depressed, weighed down by gloomy forecasts, and he offers to sell you his share for a pitifully low sum. Your job, as the rational business owner, is not to take your cues from his manic, depressive moods. Your job is to take advantage of them. When he is irrationally exuberant, you should be happy to sell to him at an inflated price. When he is irrationally despondent, you should be eager to buy from him at a bargain basement price. But you are never obligated to trade with him. You can, and should, ignore him completely for years on end if his offers are silly. This simple genius story encapsulates the entire emotional discipline of investing. The market is a servant to be used, not a master to be obeyed. During this period, he also codified his twin conceptual pillars, intrinsic value and the margin of safety. Intrinsic value is the true, underlying economic worth of a business, estimated through a dispassionate, multi-factor analysis of its assets, its earning power, its dividends, and its future prospects, though Graham was deeply skeptical of over-relying on uncertain future projections. The market price, in contrast, is merely the noisy, often irrational, and always fluctuating quote of the day, set by the collective mood of Mr. Market. The goal of the intelligent investor is to estimate intrinsic value as carefully as possible, and then to only buy when the market price is significantly below it. That discount, that gap between price and conservative value, is the margin of safety. It is not a mere technique. It is the cornerstone of the entire philosophy. It is your essential protection against three enemies: errors in your own calculations, simple bad luck, and the market's potential for prolonged, extreme irrationality. It is the principle that makes investing a risk-conscious business rather than a hopeful gamble. Act 3, The Teacher and His Prodigious Student. The Evolution of a Legacy. Graham's monumental influence was multiplied 1,000-fold through his role as a teacher, primarily at his alma mater, Columbia Business School. It was there, in the classroom in the early 1950s, that a young, intensely focused man from Omaha named Warren Buffett enrolled in his course. Buffett, who had already devoured Graham's more accessible book for the individual investor, The Intelligent Investor, published in 1949, had found his intellectual North Star. He would later call it, by far, the best book on investing ever written. Graham's teachings became the absolute bedrock of Buffett's worldview. After graduating, Buffett was so determined to learn at the master's side that he famously offered to work for Graham's investment partnership, Graham Newman, for free. Graham initially declined with a wry comment about Wall Street prejudices, but soon relented. For 2 years, Buffett worked directly under Graham, internalizing the methodology of searching for statistically cheap cigar butt stocks. This teacher-student relationship would become the most consequential in financial history, with the student eventually absorbing, evolving, and scaling the master's principles to create his own historic record. It is vital to understand the character of Graham's own mature approach. Shaped profoundly by the trauma of the Great Depression, his strategy was intensely quantitative, conservative, and focused on extreme diversification. He was the supreme master of finding net-net situations, companies trading on the market for less than their net current assets minus all liabilities, both short and long term. This was the ultimate cigar butt approach, buying $1 of immediately realizable assets for 50 or 60 cents, with the expectation of selling once the market price merely reflected the liquidating value. He was less concerned with qualitative assessments of a business's long-term moat or the brilliance of its management. His primary goal, born of scar tissue, was the absolute preservation of capital. His methods were engineered to be systematically defensive, even if it meant owning a large basket of mediocre or declining businesses that simply met the quantitative criteria of deep undervaluation. He sought safety in numbers and in the hard arithmetic of the balance sheet. The timeless lessons for us. So, what are the enduring, non-negotiable principles we can all take from the life and work of this founding father? These are not stock tips. They are the immutable laws of a rational financial physics. 1. Investment is most intelligent when it is most businesslike. This is the core governing mentality. You must never forget, not for a second, that a share of common stock is not a lottery ticket or a blip on a screen. It is a legal share of ownership in a real operating business with assets, employees, customers, and competitors. Approach every potential purchase with the same seriousness, due diligence, and demand for a good price that you would apply if you were buying the entire company outright. This mindset automatically filters out speculative fever, chart watching, and trend chasing. It grounds you in economic reality. 2. The margin of safety is the cornerstone of successful investing. It is not optional. This is Graham's first and greatest commandment. Never, ever pay full price, or even a fair price, for your own estimate of a business's value. Always demand a significant discount. That discount is your only reliable defense against the vast universe of unknowns, an incorrect assumption, an unforeseen competitor, a shift in technology, a management blunder, or a general economic downturn. The margin of safety is what separates the prudent investor, who thinks about survival, from the hopeful speculator, who thinks only of gain. It is the difference between building a fortress and pitching a tent in a storm. 3. Mr. Market is your manic, depressive servant, not your master. The daily, weekly, and even yearly fluctuations of the market are psychological noise, a continuous distraction. Your focus must remain fixed on the underlying, slowly changing intrinsic value of the businesses you own or wish to own. Have the emotional discipline, cultivated like a muscle, to be greedy when others are fearful, and fearful when others are greedy. The market's periodic extremes of emotion, its panic and its euphoria, are not threats. They are your greatest opportunities to transact on favorable terms. Ignore the mood, analyze the business. 4. The future is inherently unknowable. Therefore, anchor yourself in the known and the knowable. Graham was profoundly skeptical of precise, detailed forecasts about markets, economies, or even a company's earnings far into the future. He considered such predictions largely guesswork. Instead, he built his system on what could be known or estimated with a degree of reasonable certainty: past financial results, current asset values, the strength of the balance sheet, and a company's competitive position at present. He advised investors to concentrate their analysis on the known and the knowable, and to have the intellectual humility to frankly admit and discount for what they could not know. This forces a welcome conservatism. 5. A sound, systematic philosophy is your greatest defense against your own flawed psychology. Perhaps Graham's most profound and timeless insight was that the investor's chief problem, and even his worst enemy, is likely to be himself. Our brains are biologically wired for herd behavior, for greed in bubbles, fear of missing out, and for panic in crashes, fear of total loss. These instincts are financially suicidal. A disciplined, systematic framework, based on the cold, unemotional calculus of price versus conservative value, is the only tool that can protect you from your own destructive emotional machinery. Your philosophy must be your autopilot when the emotional storms hit. In the end, Benjamin Graham's legacy is the very idea that investing can be and must be a profession of principle, analysis, and discipline. He gave us the intellectual tools to navigate an irrational and often frightening world with rationality and poise. He taught us that sustainable success does not require a crystal ball to predict the future, but rather a steadfast, disciplined focus on the relationship between price and demonstrable value in the present. He provided the unshakable foundation, the bedrock of margin of safety and business-like thinking, upon which all modern value investing is built. He was the father of a discipline, and his principles remain, as they have always been, an unwavering light of reason in the often dark, emotional, and chaotic theater of the financial markets. Thank you.